Welcome to this class on risk analysis, part 2. In this class, we'll give a specific look at the quantitative measures of risk analysis that we have analyzed and we have introduced in the previous class. So the outline of this class is as follows. First of all, we'll look at probability distribution and risk. Second, we'll analyze standard deviation of MPV. After that, we'll analyze the coefficient of variability. Then we'll look into the break-even analysis. We'll also analyze the payback period as a measure of risk. And finally, we'll discuss the sensitivity analysis. So let's start from probability distribution and risk. Clearly, this approach is feasible only if we have some kind of expectation on the probability distribution underlying a given outcome of the project. As we know, in fact, the project can generate results that are within a large range of possible outcomes. If we have some quantitative expectation about the shape and the function of the probability distribution, then we can use the probability distribution as a way to analyze the risk in a more compelling and analytic way. And if we refer to this approach, the first aspect that is taken into consideration is the expected value. The expected value is the weighted average of the possible outcomes of a project. So it's the outcome that is expected for the future, and is the basic outcome we consider in the initial projections. Then clearly, as we have a wide range of possible outcomes, we'll also be able to calculate the standard deviation, that is a statistical measure of dispersion of the outcomes of a project, and therefore is a measure that proxies the risk underlying the project and the risk that a given outcome is different from the expected outcome of the project. The variance, that is just the square of the standard deviation. And finally, we have the cumulative probability, that is the total probability of having a certain outcome. And we'll see that this is an important parameter in the probability distribution that allows us to understand better the risk underlying the project, and therefore we'll discuss this specific aspect in more detail. So we'll hear an example of how to use cumulative probability distribution for risk analysis. In particular, here we assume that we have a given project that has some expected outcomes, and we assume that we are hypothesizing that these outcomes are distributed according to what is known as a normal or Gaussian distribution, that is the typical bell shape that you can observe in this graph. So in this graph, on the x-axis, you have the possible outcomes that a project can generate in the future. On the y-axis, you have the relative probabilities, and so the shape of the normal distribution is saying what is the probability expected for each of the outcomes that is in the range of the project. And the probability distribution allows us to determine the cumulative probability distribution associated with a given outcome. So let's assume that we have a minimum acceptable outcome under which we think that the project will fail. So we have a threshold in the outcome of a given parameter. Above this outcome, the project will succeed. Below this outcome, the project can be considered a failure. So what we can observe here is that we have defined with this yellow line the minimum acceptable outcome. And given the probability distribution here, we can determine what is the cumulative probability of having an outcome lower than this minimum acceptable outcome. So this yellow part going here also to the left, here we are not observing the whole left tail, but here there is more probability associated with lower outcomes. So what we can observe here is that the probability distribution allows us to determine what is the total probability of having an outcome that is lower than the minimum outcome that we consider acceptable. So in other words, here we can analyze the cumulative probability distribution of all the outcomes that are at the left of what we define as minimum acceptable outcome. So let's assume that this is, for example, the 20% of the distribution. So this means that we have a 20% of cumulative probability that the outcome of the project will be lower than what we define as minimum acceptable outcome. So this is a measure of risk in the sense that we know that when we start the project that with the 20% of probability the outcome will be lower than the minimum we consider acceptable, and this is a new information, useful information to understand what are the possible risks associated with the project. A second indicator of risk is the standard deviation of NPV. So the standard deviation is, as we were saying before, a measure of the dispersion of possible outcomes of a project. And however, this is clearly applicable only when probability distribution of cash flows is available. So in other words, we should define, as we did in the previous example, probability distributions for all the cash flows of the project, and then given that we can calculate the standard deviation of the possible values that the cash flow can take in the future. This data can be obtained by historical data of simulation, in the sense that clearly here we are projecting the future. So we are analyzing the risk associated with future outcomes. So we'll work on prediction and projections. We are not working on historical data, so we are not calculating the standard deviation of historical data. However, when we make assumption about the probability distribution of the cash flows of the project, even though they are predicted for the future, we can rely on some kind of information. The first information we can use is the historical data. If our company has already managed projects in the same field or within the same technological applications. So historical data can, in this particular case, represent the basis for making future projections. And so this does not mean that we are calculating the standard deviation on historical data, but that we are projecting with all the necessary adjustments historical data in the future, or just we are taking some critical parameters coming from historical analysis, and we are using these parameters for the projection of the future data. And in this way, we can assume some kind of distribution that is similar to the historical distribution that we observed for the past, and in this way we can apply the measure of standard deviation, or eventually variance if you want to calculate the square of the standard deviation. The other potential source of information about data that are needed for the calculation of the standard deviation is represented by simulation. So even though we're not historical data, we can assume some given causal relationship between the variables that determine in the end the cash flows, and then we can randomly extract from assumed distribution some values for these variables, and then test which cash flows we obtain. So if we have a high enough number of trials, and so we have for each cash flow a high enough number of values, we can calculate quite reliable standard deviation measure for expected cash flows. And clearly, if in the end we want to have a unique measure of the standard deviation of NPV, we have to aggregate the standard deviation of all the cash flows into a unique measure of standard deviation of the net present value. The standard deviation, again, is a measure of risk because it says to us in a synthetic way how much the distribution of the potential NPV for the project is wide. So it says to us what is the probability, in other words, that the future outcome will be different from the expected outcome of the project. So the standard deviation is saying in a very synthetic way important information about the dispersion, the wideness of dispersion of the NPV, the possible NPV of the projects. A third parameter we can consider in the risk analysis of a project is the coefficient of variability. So as we said in the previous class, the coefficient of variability in reality is a measure that is very similar to the standard deviation. The only difference is that in the calculation of the coefficient of variability, we start from the standard deviation of the NPV, but we divide that by the expected value of the NPV. So in the end, the coefficient of variability is equal to the ratio between the standard deviation of the NPV and the expected value of the NPV. So the reason for dividing the standard deviation by the expected value of the NPV is that the standard deviation could be affected by the expected value of the NPV, in the sense that the higher the expected value of the NPV, the higher the standard deviation, independently of how dispersed is the distribution of the NPV. So if you want to have a measure of relative risk, and from a statistical point of view, we want substantially to standardize the standard deviation for the level of the expected value of the variable of interest, we have to divide the standard deviation by the expected value of in this case, of the NPV, that is our critical variable. In this case, in this way, we are cleaning basically the effects of the expected value on standard deviation. We have a more clear and comparable measure of relative risk of a project. So now we have one of the most important risk measures and risk approaches for the evaluation of a project, that is break-even analysis. So let's start from a definition of the break-even analysis and of the purpose of break-even analysis. So the purpose of break-even analysis is to determine the equilibrium point at which sales revenues equal the cost of products sold. So in other words, the objective of break-even analysis is to analyze the relationship between revenues and costs. In particular, costs are typically divided into fixed costs that do not vary with the production volume, and variable costs that instead are proportional to the production volumes, and to see how these variables change with the different level of production. And the main question that the break-even analysis answers is, what is the minimum production that I have to realize in order not to have losses in my project? And clearly this is critical information that you have to have in the beginning of the project when you're evaluating the project to understand whether the project is sustainable or not. So the conclusion of the break-even analysis is that, as we'll see in the next slides, that when sales are below the break-even point, the project is incurring losses. When the sales are above the break-even point, then the project is generating profits. So the break-even point is really the threshold that determines the difference between a successful project and a failed project. So when we run a break-even analysis, we are making some critical assumptions. The critical assumptions are described in these slides. So first of all, the volume of production is assumed equal to the volume of sales. So this means that there is no inventories of finished products and finished goods. So all what is produced in a given year is also sold. So this is a simplification that allows us to eliminate the issues of the dynamics of inventories from the analysis. And we define as R the volume of revenues coming from the sales of the products of the projects. The second critical assumption is that by definition, fixed costs are the same for every volume of production. So fixed costs by definition do not change with the level of production. So for example, we have rents, general cost, commercial cost. A project, in order to be successfully executed, requires a lot of activities whose amount and whose financial resources do not change with the volume of production. So this cost will be the same independently of the volume of production and sales that they will attain in the project. Then variable costs vary in proportion to the volume of production. Again, this is by definition. Clearly, if the cost is variable, this means that there is some kind of relationship between the volume of sales and the cost measure. So for example, I could know that for each dollar of revenues, I have a variable cost of 60 cents. So this means that the variable cost will be equal to the 60% of revenues. And this relationship will be useful, as we'll see in a moment, to better understand the meaning and the construction of the break-even point graphic. Then the last important assumption is that the per unit sales price that we define as P, small p, and the per unit variable cost that we define as small v are the same for all levels of production. So the relationship between quantity and revenues and between quantity and variable cost are constant independently of the volume of production. Well, this is clearly a simplistic assumption, because it could happen that when the production increases, given the downward sloping shape of demand, the company could be forced to sell the product at a lower price. So here, this assumption, the assumption of constant per unit sales price, implies an inelastic demand curve, at least at the level of the firm, so that the firm can sell any quantity at a fixed price, and the market will absorb any quantity of product at the same level of price. Also, the assumption of a fixed per unit variable cost implies that there are not economies of scale affecting variable cost. So there is not an increase in efficiency of variable cost when the production volumes increase. So there is, for example, no discount on the price of raw materials, or there is no efficiency in the, for example, direct labor costs. So these are quite strong assumptions that, however, could be changed in the analysis, but probably they will not have such relevant effect. So the idea here is to make simple assumptions that give us a very clear result and immediately interpretable result about the minimum quantity that have to be produced in order to reach the break-even point. I would like also to remark that there are some costs that are not fixed or variable, but are semi-variable costs because they have a fixed component and a variable components. So they could be, for example, fixed until a given level of output, and then they could start changing from that level on. And we could introduce without particular problem in the analysis this kind of semi-variable costs, but at the moment they are not strictly needed for the analysis. However, introducing them into the analysis will not be a particular problem from a graphic or analytic point of view. So once that I make this assumption, I can start working on the definition of the break-even point. I can do that both from an empirical and graphic point of view, or from an analytic point of view. So let's start from the graphical representation of the break-even point. Here I have different lines, and then we'll see what is the meaning of each of these lines. So the blue lines that is here is the line of the revenues. So this line is clearly obtained by multiplying the per unit sales price times the quantities that are sold. So as you can see, the revenues increases proportionally with the quantity that I read here on the x-axis. Okay, then we have the yellow line that, as we can see here, represent the variable cost. Also the variable cost proportionally increases with quantity, because that function will be equal clearly to the product between the per unit variable cost and the quantity produced. So also in this case we have an increase of this line that is proportional to quantity according to this specified function. Then here we have the fixed costs that are represented by the green line, as you can see here, and is consistently with the assumption that we made before. The fixed costs do not change with quantity, so you can see that the fixed costs are constant for any level of quantity, and the green line is flat, so it's not sensitive to quantity. Then at this point we can sum up the variable cost and the fixed cost. We obtain a new line that is the purple one, that is represented by the total cost. So this is the sum of fixed and variable costs, and represents the total of the costs that have to be sustained for the execution of the project and for the production that we are considering. So what we can see here is that there are some level of quantities for which the purple line is higher than the blue line of the revenues, and there are some other level of quantities where the purple line is below the blue line of revenues. So in other words, we have an area where the firm or the project is losing money because the costs are higher than revenues. So we have an area of loss, that is this one. And then we have another area where the project or the firm are generating profits as revenues are higher than costs, and the profits are represented by the difference between the blue line and the purple line. And so we have here an area of profits. And there is here a point where the two lines intersect. So the intersection of the lines of the revenues, or that is the blue lines, and the line of the total cost, that is the purple line, is exactly the break-even point. So from a graphical point of view, the break-even point is defined as the intersection between the line of the revenues and of the total cost, and represents from an economic point of view the level of quantity that makes revenue equal to total cost. Or in other words, is the minimum level of production that the project has to attain in order not to incur in losses. This means that if we expect that there is high probability that the quantity of products sold by the project in a given year is lower than the break-even point, there is high risk that the project will generate losses. So this is a high risk project. Instead, if we believe that the quantity produced are well beyond the break-even point, we can be relatively safe that the project will generate profits, and so that the project will be convenient, and there is lower risk that the project will generate losses. So not only is it important to define the break-even point, but it's also important to understand how much the quantity that we expect to produce and sell within this project is far from the break-even point, because this is a critical information to understand what the real risk of this project is. Another information that is useful is represented by this traded line in blue that represents the difference between revenues and variable cost. So not revenues and total cost, but only revenues and variable costs. This difference is that you can see also is the difference between the blue line of revenues and the yellow line of variable costs. It's also defined as contribution margin. So this line says how much the revenues are contributing for each level of quantity to the coverage of fixed costs. So as we can see here in the graph, at the break-even point, the contribution margin is equal to the fixed cost. So this means that, in other words, you reach the break-even point for this level of quantity because the contribution margin generated by the project for that level of revenues we will be able to fully cover the fixed cost of the project. So in this way, by covering the fixed cost of the project, you are eliminating any possible loss, and at this point you have a zero profit. When you increase the quantity produced and sold, the contribution margin is still increasing, so it's beyond the fixed cost. So this means that you are generating profits and that the revenues are higher than total cost. So the break-even point can also be analyzed from a formal point of view, and we can analyze the break-even point both in terms of revenues and volume. So in terms of revenues, the break-even point will be reached for the values represented by this ratio. So the formula is fixed cost over the per unit price of sales minus the per unit variable cost. Whereas if you are analyzing the break-even point in terms of revenues, you have the product of the price times the fixed cost divided by the per unit price minus the per unit variable cost. So the fifth indicator of risk that we have is the payback period. The payback period is an indicator that we already analyzed in the previous class. In this particular case, we look again at the payback period as a measure of risk. So the payback period is, as you can remember from previous classes, the time needed to recover the initial investment through the following cash flows. And investors generally consider that risk increases with the length of the payback period. So the payback period is a measure of risk because a longer payback period signals a higher risk of the project. So the lower the payback period, the less the risk of the project. And the reason for this interpretation of the payback period is that, as we have already explained in previous classes, long-term projections are more risky than short-term projections, in the sense that it's more difficult to predict the value of future distant cash flow than the value of cash flow that are closer. And therefore, if the ability of a project to record initial investment is more based on distant cash flow, this will mean that the project has high risk because you have less probabilities of recovering the initial investment. So the payback period is an indicator that we have analyzed quite in detail in the previous classes. So the main message that we have to remember here is that it can also be considered an indicator of risk because of this property of the long-term projections of the cash flows. And finally, we have the last very important indicator of risk that comes from the application of what we call a sensitivity analysis. So sensitivity analysis is one of the main approaches that is employed in the analysis of a project to determine its exposition to different kinds of risk, and basically consists in modifying some critical assumption to see what happens with the outcomes of the project. So we can define sensitivity analysis as the effect of a change in parameter on project performance. So what does it mean? It means that, as you know, the value of a project depends on the prediction of the cash flows. So each cash flow is being predicted on the basis of several different assumptions on investment, revenues, cost, discount rate. So each of these assumptions could have an impact on the determination of the cash flow, the discount rate, and therefore on the on the net present value. Some of these assumptions could be uncertain. So this makes that also our cash flow projections are uncertain. But some of them could be more uncertain than others, and moreover could have a stronger impact on the value of the project than others. So what we do in sensitivity analysis is the following. If you have a flexible enough model for the determination of cash flows and present value of a project, we try to change some variables that are critical, some parameters that are critical, and we observe whether the results of the project changes in a significant way. So if the project changes, the results of the project in terms of NPV, ARR, or any other outcome we want to consider changes in a significant way, when we even a slight change in one of the parameters, this means that the project is subject to higher risk, and probably the estimations are not so reliable, and therefore the value that we get is probably is a scarce value for understanding the real value created by the project. So given this general definition sensitivity analysis, when we choose the parameters that have to be selected for sensitivity analysis, we refer to two simultaneous criteria, in the sense that the parameters that are used for sensitivity analysis should present both criteria at the same time. They should be parameters that are subject to large uncertainty, and they should be subject, they should have a potential large quantitative impact on the value of the project. Why do we choose these two criteria? Well, the explanation is very simple. First of all, if we have a parameters for which we are relatively certain, so for example, it could be the initial investment, we have a clear understanding of what the initial investment is and what is its cost and what is the outlay, what is the timing. We don't need a sensitivity analysis because the possible variation of these parameters are really not important, and also we will not have a real range of possible parameters because this is quite a certain parameter. So sensitivity analysis will not be applicable in this case. On the contrary, if you have a parameters that is subject to very high uncertainty, for example, the level of revenues for the product, this is a parameter that you should test with sensitivity analysis, because its values in the future could be very different from your original predictions. But the fact that the parameter is uncertain does not necessarily mean that it is to be tested through a sensitivity analysis, because it can be a parameter that in the end has not a real impact on the value of the project. So even though this means that even though if you have a large variation in these parameters, you have not a large impact on the project. So the fact that these parameters vary over time is not a concern and is not relevant for risk determination. So the other criterion that is to be respected for submitting a parameter to sensitivity analysis is that once that this parameter varies, even a small variation has a large impact on the value of the project. So this makes the parameter important to understand what is the potential range of the value of a project, because if it is sufficient to have a small variation in the expected value of this parameter to have a large impact on the value of the project. It could happen that even a small variation of one parameter could bring again to an undesirable income for the investor. So these two criteria are typically the criteria that are adopted to individuate those parameters for which a sensitivity analysis is needed. So the typical parameters that therefore are submitted to sensitivity analysis are the following: investment, but only if investment is a long-term investment and where you have uncertainty. For example, this is the typical case of the large infrastructure projects where you have an initial prediction of the required investment, but typical investment can change, as we already discussed in the initial classes of this course, for technical or for economic reason. On the contrary, if you have an investment to buy a new machinery and the price of the machinery has already been negotiated and should not be subject to contractual uncertainty, and a sensitivity analysis is not needed because there is no real uncertainty on the investment outlay. And then the typical parameter that is object of sensitivity analysis is the revenue. The revenues are typically the parameters that is most difficult to be estimated, and therefore it's correct to estimate the impact on revenues on value of the project, also because revenue are clearly one of the main determinants of the cash flow and of the value of the project. So typical revenue presents the two characteristics we were mentioning before. They are highly uncertain and they have a large potential impact on the value of the project. The production cost is also a relevant parameter because it could be that the cost of production and its incidence on revenue is higher than expected. So this will reduce the contribution margin and will reduce profits and cash flow, and in the end the value of the project. So if I am highly uncertain about the production costs, I should carefully investigate the impact of its possible variation on the value of the project. And finally, the discount rate. We already demonstrated in previous classes that discounting rate has a strong impact on the value of the project, and that given the cash flow pattern, the discounting rate can critically affect the decision to invest in a project or not. The discounting rate is the result of assumptions, as we saw in the previous classes, for example, on the cost of capital, where the cost of the equity, for example, comes from the capital asset pricing model that makes some assumption about the cost of capital. So this assumption could critically change the discount rate and in the end change the value of the project. So discount rate is a typical parameter that is object of sensitivity analysis. Then you analyze the impact of these parameters on some specific outcomes of the project. First of all, you have the typical sensitivity analysis run on NPV and IRR. So this means that you try to understand how some parameters, the variation of some parameters impact on the total value generated by the project, that as we know is represented by NPV, or by the return of the project is represented by the internal rate of return. It can be on profits, so you can see how the variation of, for example, fixed cost or per unit price or per unit variable cost affect the profits of the project at a given moment. You can work on the ratios that we have seen when we talk about static indicators of a project. We can also look at how changes in the relevant parameters affect the payback period of the project. But the main object on sensitivity analysis is typically represented by NPV, IRR, and sometimes profit. So here, to conclude this class, we have an example of sensitivity analysis. This is a very simple example where you consider the variation of just one parameter at a time. In this case, we are analyzing the impact of the variation in the per unit price on profits. You could have more sophisticated sensitivity analysis where you're analyzing the joint effect of the variation of the two relevant parameters. So, for example, the variation of price and quantities on profits, and so you will have a three-dimensional graph where you can see how the profit change for joint variation in the quantity and prices. So here we have a more simple sensitivity analysis that only refers to one input, that is price, and we are looking at the impact on variations of price on profits. So on the x-axis of this graph, we have the possible values that we assume that the price can take in the future at a given moment of the life of the project. On the y-axis, you have the relative values of profits for the level of prices that we have here. And this line is the graphical results of the sensitivity analysis, because it shows how the profits of the project varies with the variation of the price. In this case, we have a simple case where there is a linear relationship between price and profits. But clearly, when you analyze the impact of price or other critical variables on NPV or IRR, the relation is more complex and typically non-linear. where the tool is always the same. So you typically represent on a graphic on the x-axis the independent variable, and the y-axis the performance measures of your interest for risk analysis. And this line is representing the risk involved in the project, because you see that, for example, here there is some risk that is concentrated in this part of the graph, that the profit becomes negative. And so the risk is that if price is lower than 1.2, the profit will turn negative. So the risk is concentrated in this part of the graph. And if we assume that the price that we estimate is far enough from this level, we can say that the risk of the project is quite low, because the profits will probably be positive also for levels of price lower than what we have originally predicted. So this class is ended. With this class, we have terminated the part on financial analysis. So from next class, we'll start talking about the economic analysis of projects. And I thank you for the attention, and I remind you, as usual, that for additional materials, you can refer to the website of the course. Thank you.